Welcome to the Genius Factory. Enjoy the video.
In this video, I will explain how to use a ledger in accounting. First, understand that a ledger is a crucial accounting book where all financial transactions are recorded and summarized. It takes information from the journal and organizes it into specific accounts, like cash, accounts receivable, or expenses. This systematic approach helps you track the financial health of your business accurately and efficiently, providing a clear overview of your financial position at any given time. There are primarily two main types of ledgers: the general ledger and subsidiary ledgers. The general ledger holds every account a business uses, providing a comprehensive summary. Subsidiary ledgers, on the other hand, offer detailed breakdowns for specific general ledger accounts, such as individual customer balances in accounts receivable. Understanding these distinctions helps maintain organized and precise financial records, ensuring every transaction is properly categorized. Posting transactions to the ledger is a fundamental step in the accounting cycle. After recording a transaction in the journal, you transfer the debit and credit amounts to their respective ledger accounts. For example, a cash sale would involve a debit to the cash account and a credit to the sales revenue account. This process ensures that each account reflects its current balance, providing the data needed for financial statements. Once all transactions are posted, each ledger account is balanced to determine its ending balance. You sum all debits and credits for an account, and the difference is the balance. These balances are then used to prepare a trial balance, which lists all accounts and their balances. The trial balance is a critical internal report, ensuring that total debits equal total credits, a foundational principle of double-entry accounting.
Thanks for watching. If you found this helpful, don't forget to like and subscribe.